All right, good morning. Thank you for joining us again today. We're super excited to go through this timeline of our history. It was really fun for us to put together, so we hope you enjoy it. Also, as a reminder, we do have our YouTube channel. Just go to YouTube, Petso Financial. The videos will be there probably a day or so after we do the presentation, and you can rewatch or share if you'd like, and go ahead and subscribe, and you'll be alerted when those show. And also, I believe in a week or so, we're going to have a special estate planning meeting that we have one of the estate planning attorneys here in Boise that's going to help answer some questions that may be coming up next year and into the future with the election and every changes that have come up. So reminder, chat, if you'd like to ask us questions, raise your hand, we can unmute you. But other than that, I'm just going to turn it over to Dave.
All right. Well, hello, everybody. I hope I'm coming through loud and clear. I think I'm unmuted and all that good stuff. I wanted to, we are excited about this because obviously Dow 30,000 is exciting. And it's a big number. It's a very, very big number. But in many ways, it's just a number, right? People say it's just a number. It doesn't really matter. But in thinking about it, and of course, these numbers they come along, and at my age, you start to think about, as many of you recognize that there's some really big milestones in your life. And sometimes you've been around long enough that those milestones go back to pretty small numbers. And so we put together something that kind of walks through when we started. I started in the industry, Jennifer joined, and Tom Brown and Erica and my dad. And we kind of put that together and thought, let's talk about that over time and how resilient things really are. And try to remember that as we are thinking forward. As I set that in place, though, many people are talking today about how overpriced the market is. And they are. They're talking about valuations every single day, blah, blah, blah. For the last 10 years, the last 10,000, 15,000, 20,000 points, we've heard the market was too high at various times. And some of those voices ring loud and they keep coming back. And every time we get a little hiccup, then we get to parade these people out, say, see, I told you so. And it gets kind of frightening for a little while that maybe somebody does know how to time the market. And I think this kind of illustrates how difficult that is. And we'll walk through that in a moment. But I want to address the prices of today because the market is high. And valuations are high. They really are. There's no question that as we measure the market over the next year and what expectations for growth are, it's high. It's high by historic measures. But I think it's important for us to just look at this in a common sense way. Not just to say, oh, well, compared to the 1980s, this was super high. And you hear that all the time because that makes me really smart because I can go back and look at statistics and I can sound really super smart. So CNBC will put me on because I'm a really smart guy and I'm really worried about things and concerned. And that means I'm an intelligent, bright person, not just a wild-eyed optimist, like things are okay. So we got through the election, sort of. Still going on a little bit. And we do have to worry about the January 5th runoff in Georgia. But assuming, which the market is, this is not a political statement, it's just simply saying what the market wants is divided government. That's what it wants, a divided government. Markets do better, as we talked about in our last Zoom meeting. And if you missed it, that's great. As Jennifer said, go to YouTube and it's there. And you can replay it at any time. Now, when we look at valuations, though, and we think about logically, not some PE ratio, price to earnings ratio that everybody tosses out to tell you why the market is so super high. If we look at it logically, where would you put money today? I'm worried about the market. So what am I going to do with it? Am I going to say, I want to tie my money up in 10-year treasuries for less than 1%? Actually sounds pretty dangerous to me, right? Like I'm pretty sure that rates sometime over the next 5 years might go over 1%. Feel like that isn't going to happen? Okay. But is 0.9, less than inflation, clearly, what you want to do to guarantee your money? Most people don't. So we've got treasuries. They can't buy bonds. So what about if we could go out there, can we just put it in cash and earn zero? There's literally over $10 trillion in the United States alone, over $10 trillion earning zero in bank deposits. Over 10 trillion. Globally, there's $17 trillion at negative interest rates. 17 trillion. Where people are paying people to hold their money. I don't know. I don't understand it either. Honestly, I don't. I really don't. I mean, we can make up stuff like, well, insurance companies in Germany have to do this and blah, 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 and they're doing QE and all that. And so I want to do what? Pay somebody a quarter of a point to hold my money? This makes no sense. So when we talk about the market being overpriced, compared to what? To bonds and cash? Not at all. And so I think sometimes we just get caught in the weeds of discussion, worry, and it doesn't do us any good at all when we can just kind of say, does this make sense to you that I'm going to pay, let's say I'm going to go buy Chevron to just list something. Oh my gosh, it's an oil company. I hate it. It'll be under target. Yeah. And it pays like 6% dividend. Do I want to own that or cash? Do I want to own Pfizer that yields over 3? The drug maker. Not just because of the vaccine, absolutely not because of the vaccine. That's going to be here today, gone tomorrow, and they are a huge company. This isn't even going to move the needle for them. But just day-to-day drug sales. Would I rather have a 3% and over time it's always been growing dividend, or do I want to tie up my money at 0 and then wait till God whispers in my ear, this is the time, now, invest now, and then invest in what? Now, are there areas of the market that give me concern? Absolutely. There's no question that a lot of you hear about the Robin Hood investors, the people that are day trading at their computers at home, right? That's a problem because everybody's trying to hit that lottery ticket because there's a lot of fast money out there right now, right? I could have made a gazillion% in Zoom. Yeah, you could have. Should you keep trying to right now? What about Tesla? I could have really gotten Tesla and it's going to be great. It's going to be added to the S&P 500. Yeah, at infinity times earnings, maybe, yeah, I don't know. So there's money chasing hot areas. But looking generally at the market is where we get in trouble sometimes. Not generally, we'll look specifically. I could have been here, should be in tech, I should be there. People chase all the time, and people do. Sometimes our clients do. How come I'm not in all the tech? Well, you're never going to be in all tech. That's not proper portfolio management. You need to be diversified. And especially if you're wanting income or you're more concerned about volatility in the market than others. You can't just be having market volatility. So you need to have balance in your approach. And I think that's particularly important now because some of the valuations on some of these red hot areas in my mind are high, but overall to the market, nah, market's fine. It's fine. Relative to everything else. It's cheap relative to anything else. Money finds its way to what it wants to be in, what it sees as cheap, what it sees where returns are. Is there gambling going on in Wall Street? Of course, on some little stocks. That's not what we're talking about. Real investors are bringing money, thinking long term. So let's go ahead and talk about the Dow 30,000 and the march to 30,000 because it's so amazing. It really is. And I just want to start with this. I started off in 1980s, okay? Prime interest rates were 21.5. As I try to remind people, this was a gruesome time. And I moved to Boise. I was 19 years old. Couldn't get a job. I actually came here to get a job. And I'll tell you, it's one of the most, if you will, God's wonderful intervention in my life. The guy didn't like me. and I didn't get the job. So there I was without a job. I needed a job. I mean, I need a job now. I had a 2-year-old child. Yes, that's another story. And so I needed to get a job. And I was able to find a job selling insurance and then getting licensed. And so basically it was 1980. Interest rates were at 21.5. Pretty tough. But look what the market did. In spite of that, we, of course, had a big change when Ronald Reagan was elected and then re-elected in the landslide in 1984. We went from 21.5 interest rates. Rates started to drop. But I remember at that time in the early 80s that the pundits, the experts told us interest rates would never drop below 10% again. Well, we all know that that wasn't true any more than rates will always be at less than 1% today. Rates change. The world changes. But what's important to understand too is when I started in the business, the Dow Jones Industrial Average was at 800. By the way, just as a point of reference, and you'll see this later, gold was at 850 at the same time. $850 an ounce. So times were a little tough in the 1980s, but look what the market did. It's an amazing climb, just a stunning climb. In spite of things like Black Monday in 1987, and just to remind everybody, that was when the market fell 23.5% in one day. One day. Pretty tough day. But it's interesting as we look at the market during that time. And by the way, the reason there's two lines here, one is income, one is no income. It's just the price of the Dow. So you'll see how big that becomes in the end. Because the only thing that really matters is total return. And if you're getting 3 or 4% dividends, which you were in the 1980s, actually 4 and 5% in many cases out of the Dow, that is a big component of your whole return, as you can see right here. All right, and then also just as a sideline, because this is our story too about when we started. That's when actually I started on the radio is in 1989. So pretty young at that time. Okay, now let's talk about the 1990s because that cute little girl in the middle is Jennifer, and she was pretty much a little girl at that time, almost a little girl, but she was a very young woman at that time with a child and a husband, and had come to Boise, and by luck. She came into our office and we worked well together. So we stayed together and she's still here. So here we go. 26 years later, Jennifer is running our office, actually has been for years now. But remember the 1990s, all easygoing, not so easygoing when we think back. We think back about what happened with the Gulf War. And okay, it wasn't a big deal as it turned out. But man, there was a lot of fear. Do you remember how the pundits again were telling us that when they dropped bombs in the Iraqi desert, it was going to ignite all that oil, and the world could possibly go into a blackout winter? But seriously, these were the Al Gores of the world. They were really smart. People listened to them and scared people to death. We weren't going to win. We weren't going to win easily, and oil prices would spike. The economy would be ruined. Whoops. The market did fine. And we ran into, the only problem we ran into, and I have to put this, or Jennifer put this on, it was great because I've talked about this many times. Air.com. Like, really? Tech stocks, this was our biggest time of underperformance because we didn't just buy tech stocks, but the market only did. And it was air.com. All these companies were IPOing, and it was like, profits don't matter, nothing matters, sales don't matter. Just put a .com behind and run an IPO and you've got it, right? So in this wonderful decade that really ran straight up, it was an amazing decade. Even by the end of it, we were worried about a number of things. We weren't worried about the tech companies, but we were worried about Y2K. Now, I love telling this story because it just shows human behavior. And in spite of all of that, the market's done very, very well. But in spite of human behavior and silliness, because I remember, I was still fairly young then, we were going to go down to the big millennial celebration at the Capitol building and at midnight. So we were just kind of resting. It was about 5 o'clock in the afternoon. The 5 o'clock news came on Channel 7. You can see the icon there because that's when I started doing reports for Channel 7 was 1992. And then, so Y2K is coming, and they flashed to Channel 7's reporter who was outside Coppell's Browsville. Now, I know they're not in town anymore, and those of you who are maybe don't remember they were here, but that was right there, Shinden there at the connector. And you remember this was a Army surplus store. And the big news was they're out of water. Now remember, this is New Year's Eve in Boise, Idaho, 5 o'clock at night. And so all day, the lights came on, the boats floated, the elevators worked, the airplanes stayed in the air, and no missiles were launched in China, Russia, Australia, all the way around the globe, all across Europe. The lights go on, the water is going, everything's fine. But in Boise, Idaho, we're out of water, and anytime soon, in 7 hours, we're going to strike midnight. What's going to happen? Even at that point, all the evidence of the world says, obviously, nothing's going to happen. So all those doomsdayers, all those people, and remember all the ads that ran and the emergencies, sirens in the background. It was crazy, absolutely crazy. We were worried about it. Nothing. And the market ends the decade with another fantastic gain. Tremendous. Now, as we get into the 2000s, not such a fun time. We finally have the tech bubble burst in 2000. Finally. And boy, did it burst. If you were an all-in stock, I mean, this was a disaster for some people that had many people that had no diversification. 2000 was a funny year. It really was. You had the NASDAQ falling from peak to trough. It finally went down 80%. 80. The overall market went down 50 because it had so much of the content of the market now, the S&P 500, was in fact tech stocks. Obviously, not all stocks went down. 2000, actually more stocks on the New York Stock Exchange were up, not down. Only tech was destroyed. We then had the tragedy of the Twin Towers, sending the economy into a recession in 2001. Perfect timing for us to separate out on our own and become Petso Financial. In 2002, the market finally, after a 50% drop, 80%, as I mentioned, on tech, bottoms. And then later on, Tom joined us and my dad joined us, but the market didn't like my dad joining us at all in 2007 as we entered the Great Recession. You'll see the phone on there. That's when the iPhone was invented. And I think it's so important to think about that and the innovation that happens, because the iPhone kind of changed the world. It kind of did. A lot of apps, a lot of phones, our smartphones, the way we communicate, whether it's texting, and not just that, we get our emails there. We get our directions. Siri, help me find this. Put on my calendar that. All of those things are done with a smartphone. Thank you, Steve Jobs. It's a beautiful thing that changed so many things. This is called the lost decade. And during the lost decade, your portfolio, when we started at 10,000, is now almost 300, isn't any higher at the end. It didn't do anything. Didn't do anything. The lost decade for stocks is what it was called. And the Great Recession just devastated that, and we ended that, although it bounced back, as we know, and then the 2010s. And again, not just the story of it, but the understanding here of how resilient things are, in spite of worrying about the Greece crisis, which is what this little guy is right here. Remember that? Greece, with the GDP about the size of Vermont, was going to take down the whole world. And that's what the pundits told us. That's what we needed to worry about. That QE 1, 2, 3, and 4 were a disaster. And as soon as they took that money away, it was all going to go flushing down the toilet. We were going to spiral out of control. You need to buy gold. You need to hunker down. You need to listen to all those dried up, movie stars, not movie stars, but actors. Because I really care what they have in their safe. Don't you? I want to know what some guy, I couldn't tell you what his name is, but I've seen him on TV before, has in his safe. That's what I want to know. That's the silliness of this and how easily fear sells. We actually, in 2012, we bought the building down here, and so we have our permanent location. But we often forget in that time frame how we keep coming back in 2011 and 12 with more worries about Europe dying. We keep forgetting about that. All the debt spiraling out of control. Do you know at one point we were seriously worried about a nation of Crete? Now, my guess is it's not as big as what? Let's say it doesn't run from here to Mountain Home. It's a rock. It's an island. It's an island that they have, where basically the Russian mafia launders money and holds stuff there. Okay, that's all it is. But Crete was having a financial problem, and Iceland too. And these are two giant economic powers of the world. But this is going to be news that drives us to worry about it. And then we did almost try to drive ourselves off a cliff with the fiscal cliff when we actually lost, the United States of America lost its AAA credit rating. These were real market concerns at the time. And we look and laugh it off as no big deal because that was ancient history. And so once again, our accounts all grew in this decade, 13.5%. What a rise. In spite of terrible political division. And it still is something else. Not done. We're not done with that. And what I think it does is it takes us to this point. I want to share this. And of course, we got a little cute thing here with Erica. She's joined us now, and we're very happy to have her on our team as well. But this is what happens when things work out. And again, I it's funny. I went to the dermatologist today and did my whatever annual check, which is even she told me you don't need to come in every year. So that's nice, right? That's good. You always want those things. But I look down, I'm looking at my hands, and I go, those can't. I was joking, of course, but it's like those age spots and stuff. I mean, those aren't my hands. Where are my hands, right? And we all feel that way, but it also gives us a chance to reflect. 40 years, and we're not done. Interest rates as high as 21.5, as low as 0. Who'd have predicted that? Incredible, amazing presidents like Reagan. And political turmoil like we've had in the last 5-6 years. It's quite a shift. Who'd have predicted that? A financial meltdown that we worried about what was going on globally. All of that. And more. So much more. Market crashes, corrections, interest rates going up 6 times. Oh, we can't raise interest rates. We're all going to die. I mean, you hear it all the time. As soon as they pull QE away, we're all going to die. Market's too high, too high, too high, too high. If you just held on, $10,000 has grown on the Dow to over 300,000, 315,000. That's the Dow. And I'll tell you how misleading the Dow is. It doesn't include dividends, which makes the blue line like completely irrelevant. But we got to show it because otherwise, if somebody's going to go and do the math and go, hey, your percentages you showed are not accurate. They are. We didn't make them up anyway. We just had, had the computer run all these things, right? Jennifer did, and a great job on this, Jennifer. Great storyline. When you reinvest dividends, which is the only way to measure any investment compared to other investments, or they all pay out. You can measure them that way too. Then you wind up with an astounding $755,000 more, or $1,071,000. Astounding. Now, I have to talk about this. It's really not about gold, okay? But everybody wants to talk about gold. But this came about, and I said, we got to tell people what this number really means. Because it was a long time ago, 1980. A long time ago. So in real dollars, what does that look like? So we took a few things. Well, what if I just put it in treasury bills, right? 3-month treasuries, rolled them over all the time. Man, that started off great. No doubt about that, right? Interest rates at 21%, that's pretty good return. But we know where they are today. 3-month treasuries are what, 0.15, something like that? Anyway, you're going to see that. You can barely see any of those. They're right here. Okay? We've got inflation. $10,000 of inflation growing to $31,000. Not 1 million. 29,000. Gold. You know, a good place to hide, always holds its value. The real money. It's not a fiat currency. It's the real thing. Didn't keep up with inflation. 22,000. Because gold doesn't do anything. No return, nothing. It just sits there. It's a pretty brick. Good. Fashion it into a ring, give it to your wife. She's happy. That's the only function. Gold doesn't have a function. It sits there, looking pretty. That's all it does. So I have no idea why we waste so much time talking about gold, but we do. We do, because it's a fear thing. Gold or an equity index annuity, same thing. Same pimps pimping them in fear. Same exact thing. Then we have treasuries. At least you're getting some interest. You get 52,000. That's these little lines down here. Here's the Dow with the income reinvested, a one-time $10,000 investment. This is why we invest. This is why you put up with this and that and that and that and all the other little things in between. And when we sit there and worry about all that other stuff, we get deflected from the reality of the long term. Dow 30,000 is important because it allows us to stop and reflect where we've been, how many things we've gone through, that this works. It always works. It worked from here. It worked from there. It worked from there and there and there. It's always worked. It's creative destruction at its best. It's Apple taking out BlackBerry, Nokia, with better stuff. Increasing earnings overall, increasing the economy all by itself. It's Boeing making incredible airplanes. Yeah, I know they fell out of the sky last year. That was a problem. But by and large, the supply chains that provided for these companies, how well we live is unbelievable. We spend so much time sitting and fussing and worrying. And I know it's been a hard year. It's so hard. It is. Go everywhere with a mask. You don't like it. You're afraid of getting it. It's all those things. Thanksgiving has changed for so many people. Can't go see grandkids. It's hard. So it's important for us to reflect on this, not with a Pollyannish attitude, but a real reality looking back and knowing this works. Whatever happens, whatever nut jobs are in the White House and trying to ruin things, figuring out how to destroy the economy, they can't do it. They tried. They've tried many times. Increasing regulations and taxes and trying new things that have never worked. All kinds of stuff. This is what happens. It's amazing. You can see the returns. And with dividends, it's the only thing that matters, but we put the other line in because of the math, right? Because it doesn't take a rocket scientist to say, hey, wait, 10,000 to 300,000 on the, or I should say 800 to 30,000 on the Dow isn't 10,000%. It's not, but it doesn't include dividends. That'd be like showing T-bills without any interest, wouldn't it? Really would. So you can see with the dividends how important income is. And so I want to reflect on that for a moment and then take questions, okay? My quick reflection is this. When we're talking about income planning today, what do you own? Does it matter who's in the White House or what other things we're worried about if you're receiving dividends that are increasing every year? It doesn't. That's what we need. We need income coming in all the time. Instead of focusing on price, we need to continue to focus on value. Those things that are feeding in when people are drawing income. And I use this example all the time. Franklin Income Fund didn't change its dividend, not one fraction of a penny. Hasn't for 3 years. But the point is, it was the same in February before the meltdown as it was in March and April and May and June and today. It's the same. So is Pfizer's dividend. So is Chevron. And many others. Collectively, dividends rise over the years by 3 times the rate of inflation. That's what we should be concerned about. We're not. We're all concerned about price. What the market do today is not, did the dividends get paid today? That's never the question. Or do you think the prices are too high? No, relative to everything else, I do not. Do I think we chase in some of these little high-flying tech areas? Of course not. Are there problems in these SPACs? And I'm not trying to get in the weeds, but yeah, there are. There's clearly irrational exuberance, if you will. But this chart just says it all, doesn't it? We were exuberant many times here. It works. If we sit on our hands, relax. It's a beautiful ride. And it's a beautiful ride to financial security, however we look at it. And today, I'll add this. There's no other alternatives. There just aren't. We look every day, every day, every day. Give me an alternative. There aren't. Every day, we're looking for stuff that isn't stocks. And there are some things, but very few that you can. And that's why we continue to be bullish. I think money continues to find its way in. All right, with that, let's take some questions, Jen.
Okay, as a reminder, raise hand. There's a couple on the chat. Dave, do you see that? Maria sent you a couple. Okay, perfect.
Okay. Is there any connection with the increase of spending to the deficit to the increase of the Dow? Absolutely, but less than people think. The point there is that, and I think it's a good one, with interest rates this low and money pouring into the system, is it finding its way into assets, meaning stocks and things like that, higher risk assets than just sitting in cash earning nothing? The answer is yes, there is clearly some of that. But as far as the overall economy, and this is an unfortunate part of what I'm afraid we're going to see coming forward again, is the idea that spending, deficit spending, government spending, is a net positive to the economy. And it's not. It's a net negative. It's been proven that it is, but we still try it because that's what was taught 50 years ago, 40 years ago, and what have you. The government cannot stimulate the economy. It can on a short-run basis by a little bit, but the dollars it spent doesn't work. So what I'm saying is that yes, it has helped, but what's really helped has been really the technological improvements have made the economy really ramp up on its own. We think about this all the time because we had more administrative staff when we weren't a billion-dollar firm. I mean, seriously, what we had, what do we think when we branched off on our own, Jen? We were 100 million, as we were talking the other day.
Yeah, real close to that. Yep.
Something like that, right?
Yep.
And so $100 million or so, and that has gone up tenfold. And we're looking at a circumstance now where we don't have as many administrative people. we're able to trade easier. And this you multiply out across every industry is a stunning progression and creates great productivity all across. So it's not stimulation by the government that has helped so much, but it does on the margin help. But the net effect is we have to pay this back at some point in time. And the net effect is by taking money out of the most productive hands, which is businesses and people that are paying taxes, and then putting it in the government, sloshing it around, and then and slicing it up with bureaucracy is not positive to the economy. And that's been proven over and over. And obviously it's logical. It's not going to be, because businesses are creative and productive instantly. If it's not working, you're out of business. Guess what that is? That's called motivation. Let's get this right. And so businesses are very, very creative in that. And hopefully that answers the question. I don't want to go on too much there. What happened to my screen, Jen?
I took away the sharing, so you should be able to, at least the only other question on there is, and Maria, I'll answer that one too, because we worked in doing the trading and everything here, and we didn't have to buy new computers. We actually had to upgrade a few things and do things a little bit different, but we did not have a lot of outflow at that time. We kept all of our same technology. The software changed a bit, but we did not have to buy new computers.
You know, that's a really good point, Jennifer. I think that was one of the most amazing things about Y2K. Really stunning. China and the Soviet Union said, we don't have any money. Remember, the Soviet Union had melted down and they didn't have any money to fix anything. And so both of them said, no, we're not doing anything with the computers. They literally did nothing, and it didn't end the world. And of course, like Jennifer said, there's no way that the tech firms could get all of it done in the first place, and we didn't. And we didn't buy new computers. So good point. But that is it was a fascinating point to me in time, because although we laugh about it today, it was very frightening for a lot of people, and irrationally so. Mike asks, 2021 is looking like it's going to be a good year, especially compared to 2020. I think anything's going to look like a good year compared to this year, right? What are your thoughts, and what sectors are you looking at? Thanks, Mike. I'll tell you what, we're having a hard time finding real bargains out there. I remember on our last call where we kind of came into the election, we felt like it was okay to hold a little bit of cash, and in many cases, it's not cash, but cash-like circumstances in case things got out of hand. And one of the great questions we had is, when are you going to put that back to work? And it's like, when we get a correction, they always come, and we haven't had one. And so we are kind of looking at some different areas, probably more towards the value side. We don't want to chase growth. It's really done well, as we all know. The NASDAQ's risen tremendously this year. But I do think that we will continue to get corrections. I'm not saying we're going to go from 30 to 28 or anything. We just try to buy in different, like, for example, I'll just give you a name, and I'm not saying go buy it, and I'm not saying you're going to find it in your portfolio. But one that we are looking at, for example, is American Tower, which is it builds cell towers, right? And 5G is a big deal. Well, it hasn't gone anywhere for a long time. And if some of these tech stocks pull back, which they're a little bit out of favor right now, or stuff like American Tower pays a dividend, raises it every year, those are stocks we like. And so if it pulls in, we think that's good, but saying the overall market is a bargain, no. So sectors we're looking at very, 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 very hard right now. The most bargain that I see out there, and I hate saying this because it's been so wrong for so long, is emerging markets. And because with the vaccine, they're going to be the biggest benefactors, getting them back online and going again, and not having everything globally shut down. So the global economy, to me, is going to be the big benefactor. So if you're thinking US, I would think international stocks, meaning the multinationals selling a lot of goods and services overseas, whether that's a 3M, companies like that sell a lot of stuff overseas. I think they're going to do well. And they also pay good dividends. So they're really on our radar screen for that. But I can't say one sector over others. And right now, healthcare, I would say absolutely. But one thing with healthcare or other sectors that I would say, you got to be in robotics. artificial intelligence, 5G, all those things, but they're not bargains. You just have to stay there. Got to be there, stay there. And because that's where the world's moving. But for looking for bargains, Mike, I got to say this is there aren't a lot of them out there, and they're popping up in different sectors to me. Okay, great question. The big corporations I worked for did, and we got a new PC. Okay, new electric vehicle facilities being built in Casa Grande, Arizona. Auto. Okay. Any other questions? Jennifer, is there anything you want to add?
Nope, that was excellent. I actually enjoyed the history too. So it was very fun to do, and I'm glad it went off really well. Good job.
Well, thank you.
Yeah.
Everybody, we appreciate you. And again, if there's anything you wanted to review, any of the charts and stuff, my gosh, YouTube, don't forget about the YouTube channel. We're hoping that becomes a very good outlet for us, because we know, we are so happy you're on the call. But we also know that there's some people working in that would have interest in this, and so we want to be able to get there. And what was it else? We subscribe. Is that what you do, Jen?
Yes.
As well, to get notifications.
Yep. That way, when we add a new video, you should be notified if you're subscribed to the channel.
Okay. Very good. So we hope that'll catch on, and the reason why is we can also add things instead of doing a Zoom meeting, and it might be a 5-minute thing that people can go to. So subscribe if you have time, and thank you again for spending time with us. Oh, what about cannabis stocks? Great question. Okay, that didn't pop up on the screen, I guess, but anyway, I think it's an interesting question I want to answer for everybody. The answer is yes. The answer is yes and no. I went through a pot farm, just several years ago in Oregon. I'm going to say 3 years ago, but not several, but a few years ago. And one of the things that really struck me, yes, it's very high end, very clean, all those other things. But I wanted to understand the industry a little bit. And this particular place had spent a lot of money on their equipment, and they can't make money. Here's why. Yes, everybody's smoking pot. Yes, the whole world's going to smoke pot. It's going to be legal. It's going to be fine. And people are going to nationalize. It'll become legal. The problem is it's a weed, and it's easy to grow. There's too much pot. And so that's why you're finding so much of it on the black market. You can see articles in the Wall Street Journal if you want to follow that up. There's lots and lots of articles in the Wall Street Journal that talk about the black market pot in California and Oregon that's making its way out all over, because they can undercut with the taxes of the states because they can't sell it and make money. So the problem I see right now is distribution, and these companies have to go away. There's too much of it. How are you going to buy it and hold it? I just don't know what to buy. Do I think cannabis stocks are interesting to look at? Yes, but I've seen them go, like Tilray, I think it was, came to our attention early on as one of these big Canadian firms. And I've never owned it, full disclosure, but yeah, I know it ran up to like $250 and down into the single digits again. Very volatile. I would be careful there. And I think long-term, you're going to see a lot more of this. But until the industry distinguishes, like the computer industry did years ago, when we saw all of these little computer companies that were the innovators and creators, they all disappeared, right? They all went away until it consolidates to the big guys, like as we saw the Dells, the Compaqs, IBM, and some others that they all made some money from them, but all the others that started the whole industry went away. So be careful there, okay? That was a long answer. How much does Biden and his appointees affect the market? Great question. It does. The appointees are the real big deal. Nobody thinks that Joe Biden is going to have a strong presidency. Nobody knows how long it's going to last. He obviously struggles with some memory issues. It's pretty clear that he does. So nobody thinks that. It's going to be the people behind the scenes that we don't know. And whether Biden makes 4 years or not, it's going to be those people there. As far as the Senate and why the market is liking what's happening now is because of divided government. So I think I talked about that earlier. But focusing on that, for example, Janet Yellen was a great appointment. Why? Because she's considered to be very moderate and has been around and experienced. Now, I mentioned this before. She's a Keynesian economist. That means government spending. I don't understand that. It's like going against the facts. But at the same time, I don't see her as being a crazy person. And the market doesn't. And that's why the market rallied on that. So the appointments, watch them. And the other important point there is we don't have Elizabeth Warren Treasury Secretary. That's one of the things that you saw repeatedly concerned about in periodicals like the Wall Street Journal. Very concerned about some kind of a super radical agenda. That doesn't appear to be the case at all. And so that's why these appointments are coming through okay so far. We'll see how the rest unwind. Great, super great question. Will RMD reject January? Required minimum distribution reject in January? No, if people are set up, they'll come out automatically. So if you're set up to do that automatically every January, it'll come out. You can always roll it back in if the rules change, but I doubt they're going to go 2 years in a row without required minimum distributions. Further, the economy is really rocking right now anyway, so there's no reason for it. And the market is doing very well too. Okay. Anything else? Any hands up?
I don't see any.
All right. Everybody, thank you again for tuning in. We sure appreciate it, and have a super day. And again, it is exciting to be at Dow 30,000. It really is. And it's okay to be happy. Let's be happy about it. Okay, have a great day.